actually one of my favorite sessions. It's very basic, coming down to visual chart analysis. By the way, I love the word visual. As Chip said earlier on, the word technical is a very strange word. I don't know where it came from, and it scares a lot of people. I know it scares people in the media, but it just scares people, and it's really unfortunate. In fact, I wrote a book while I was working at CNBC. I actually wrote a book called The Visual Investor, and that was actually the suggestion of the publisher. He said, you know, if we call it technical, it was written for the general public. And if we call it technical, it's going to scare people away. Why don't we just call it visual analysis? And that's what I do now. I just call it visual analysis. And that's really what it's all about. It's looking at charts and patterns and things like that. It's very basic stuff. But I have to tell you that after 40 years or so of doing this, and I've gone over the years through every imaginable theory, you know, Elliott wave, which I still use, Gann analysis, cycles, and I've used probably, and I've really come back to some fairly basic stuff. It's really basic, very basic chart analysis with a handful of very simple indicators is really all you need. Anyway, let me just walk you through this, and it's nothing very difficult. It's all very basic. Just to reiterate a little bit of what Chip said, fear and greed move markets right now. We're in a fear period, as you're aware. TA tries to detect fear and greed's effects while they are still happening and take advantage of the resulting trends. Fear and greed's effects create stories on the charts, that is chart patterns, and that's the next thing that we're going to get to, chart patterns. This is one of my favorite areas, and we'll get into it. First of all, bear in mind there's nothing magical about these chart patterns. In fact, if you break them down, they make perfect sense, and we'll explain a little bit here, and as we go through the weekend, we'll point this out. It really comes down to support and resistance, and you know, we put fancy names on these things, but they're really very, very simple. Nothing's guaranteed, of course. Everything, all opinions are subject to change, as you know, from morning to afternoon. One of the criticisms of chart patterns, by the way, is that they are highly subjective. There is some truth in this. This has been a criticism of chart analysis, is that it's all in the eye of the beholder. Well, there is some truth in this. Different people can look at the market and see different things. Academics have often used this as a criticism. However, bear in mind that a lot of this is now computerized. For example, I helped develop a program with Metastock. Am I allowed to mention them? Sure.
We still sell it.
Actually, it's too late. I already did. We're not in competition with Metastock. It's really an excellent software program. We developed a chart pattern recognition program that we taught the computer to recognize chart patterns. And we could actually screen all through the data and tell us this pattern's forming. And I see ads on, I think, E-Trade or Ameritrade now has them. So you can computerize these things. So it's not all that subjective. Okay, I just wanted to make that point. They are useful in the same way that weather forecasts are useful, although I like to think we do a little better than those weather forecasts. We don't get away with saying it's partly sunny or partly cloudy. I've never understood the difference between those two. Partly sunny and partly cloudy, they're sort of the same thing, right? Okay. It's like these guys that get on TV and say the market's going to be very volatile next week. I say, what the hell does that mean? How many people have you heard say that in the last 2 weeks? I think the market's going to, would you buy or sell here? Well, I don't know, but I think this market's going to be very volatile. What the hell does that mean? It's going to go up, going to go down? I don't know. I don't know what it means. Based on a combination of support, resistance, and trend lines. In fact, that's really all it's about. If you understand the concept of support and resistance and the drawing of some simple trend lines, these patterns are very, very simple, and there are only a handful of them. Charts are battlegrounds. By the way, I have to say, Chip put these charts together, and I've noticed he has a very violent streak. You'll notice over the weekend, a lot of his things are wars and battlegrounds. So, anyway, it's not an aerial picture of some World War I trench lines. There were times when the battle between the Bulls and the Bears resembled the front, with World War I, both sides firmly dug in, convinced that their stock valuation is correct. Although I have to admit that there have been times over the last couple of weeks I felt like putting a helmet on. But anyway, in charting terms, a stalemate is called a trading range. Prices bounce back and forth between support and resistance levels. And that's the chart you see now. You'd be surprised how often markets are in trading ranges or sideways patterns that are very inconclusive. A lot of people think the charting is very precise and you should always have an opinion. Well, that's not always true. I find that there are many periods of time looking at the market where you just scratch your head. You know, the market, we had that over the summer where the market was kind of moving sideways. You could make cases for going up cases, and there are long periods of time where the market is just indecisive and your technical indicators are somewhat indecisive. What you really have to do in such times is, I think, kind of back away a little bit. And obviously, there are days where we just don't write anything, or I don't do anything myself because I think the market's confusing. You have to wait for those instances where the market really tells you something is important. But anyway, here's a good example of a trading range. During the first half of 2011, Apple was stuck in a trading range between 325, that's the support level below, and 355. Resistance level above. And remember, resistance is always above the market, which is the red line. Support is always, that's kind of self-explanatory. So there was a mammoth argument going on between the number of bulls and the number of bears and what the market value of Apple should be. In mid-June, where was this? In mid-June, we dipped to 315 and things looked a little bleak for the bulls. But we're going to come back to that slide a little bit later. Let me just go back to that. So just bear in mind where that is. This is in mid-June. We're in the lower end of the range, and we're starting to come back. Anyway, we'll come back to that a little bit later. Just wanted to show you, volume also plays a very important role in chart patterns. We say price is all that matters. Well, that's true. Price is all that matters. But when I, in fact, earlier on when Chip showed market action, actually I pointed out, yeah, it's mainly price, 70, 80% price. But volume is also important. That's also part of market action. So we also, as technical people, we do pay a lot of attention to volume, and there are lots of ways of doing it. This chart is a chart, it's called the volume by price. Let me just, first of all, it's a bar chart. You can see the lines along the bottom. That's the traditional way of showing a bar chart, where you have prices moving up and you have volume along the bottom. Those bars along the side, it's the volume by price overlay. It shows how much volume happened at various price levels on the chart. It finds making support and resistance levels very easy. For example, if you can see a little bit to the left of the chart, there were two areas where the bars are, the sideways bars are extremely large. For example, you'll notice to the left there, between, I don't know if you can see these numbers, but this stock, this is IBM, trading sideways between 140 and 145. You can see that. There was a lot of volume. That meant there was a lot of churning going on there, a lot of volume. When the market moved above that, turned above that right in the beginning of 2011, and then you notice that we hit another period of churning. When the market pulled back, whenever the market pulls back, you're always saying, well, where's there support under the market? One of the best ways of finding out where there's support under the market is where there's a lot of trading volume. We'll get into that a little bit later when we talk about how resistance levels become support levels. But usually if you have a period of a lot of volume below the market, when the market pulls back, that will act as a good support level. You'll notice, for example, then during February and March, the stock started churning again. Notice those sideways, a lot of trading volume. And then when the market broke out in May, you'll notice during the pullback in June, where that second line is, that became a new support level. So it's just a different way of looking at volume. It's there, it's for you to use. I must admit I don't use it maybe as much as I should, but it is there. A lot of times if you're looking for a pullback and you're looking for some support, by looking at where the volume took place, sometimes that can be very helpful. So you just should be aware that that tool is in there. This idea of support becoming resistance is one of the more interesting aspects of support and resistance. We all understand, or most of us understand, that support is resistance is a peak above the market, support is a level below the market. But they have a tendency to reverse roles. For example, this is a chart of IBM. The bulls that bought at 76, let me just hit this, okay. The bulls that bought at 76 were gleeful and very happy at 90. And there we go. Remember, Chip did these slides. And suicidally depressed at 66. I don't know about suicidally, but certainly they were blue. There you go. That's a bad pun. Suicidally depressed at 66. And this brings us to the trader's prayer.
I'm sure no one is familiar with this prayer in this room.
I don't know if it's right to actually pray when you do this. Is it right to pray? Are we allowed to pray?
Yeah.
Bear in mind, let me just go back to this point here. Oh, no, I screwed that up. I'll get back to it. I'll get. Oh, I'm hitting the wrong one. Okay.
Wait for it to turn green, and then you can go again.
We're going to talk now about support turning into resistance and vice versa. Notice that the stock is down at a much lower level. The people who are issuing this prayer that we're about to show you are the people who bought at the green line. Okay, everyone, when that stock hit a new low in April of, what was that, 2005, everyone who had bought the stock before that had a loss, hence the prayer. Dear Lord, it's me. I'm not going to read it. Okay, you can read it. I don't like to pray for these things, but anyway.
Please get me back to even. I mean, that phrase should ring true with many people.
In other words, all you people who did not sell, say, 2 weeks ago, I probably said this prayer in one form or another, that if you can just get me back to the price of 2 weeks ago, I promise I'll sell this time, right? That's sort of the same idea. And you promise I'll never do it again, but that we always do. Well, let's move on. Then the stock rallies, and you notice it rallies right back to the green line. Now, that had been support in the past. You see those three arrows to the left? In other words, the point of this is that when a support level is broken, it tends to function as a new resistance level. In other words, the stock broke that support, it rallied back up to that line, and all those people who had bought earlier on were very happy to get out when they broke even. So that is why support becomes resistance. It's a little lesser known aspect of charting, that a broken support level becomes a new resistance level, and by the same token, a broken resistance level becomes a new support level. We'll show you many examples of that, but let me just continue with this. Oh, there you go. Sorry,
Yep.
Chip, I'm screwing up his
That's all right.
beautiful slides here. I'm out of sequence. Here we go, battlegrounds again. Prices break out and start to advance as one side gets the upper hand. Trends, slanted support resistance lines. Trends can be thought of simply as slanted support resistance lines to a point. If the line is slanted upwards, the bulls are winning. If the lines are slanted down, the bears are in control. What could be simpler? Let's look at an example of an uptrend and see the exact steps it goes through in order to become an official validated trend. Trend identification. It's all very simple. But most people on Wall Street don't know this. Okay, here you go. So this is for the people on Wall Street. People at CNBC. Here you go. Peak 1. Okay, then you get a little pullback. We break through that. That becomes trough 1. Any questions? I'm just kidding. There you go. Peak number 2. There we go. New high. Trough number 2. And we draw a trend line. Okay, so with higher peaks and higher troughs and a validated trend line, obviously it looks very bullish. Now we're ready to go back and look at that huge battle that was happening with Apple during the first half of this year.
Actually, we have to validate the trend line with the third point. So with two increasing troughs, you have a very good chance of a solid trend line happening. You can draw a trend line, though, between any 2 points. You really need 3 points in order to get a valid trend line. And so in this theoretical model, that we put in that third higher trough. And with uptrends, you are only concerned about the troughs. With downtrends, you're going to be concerned about the peaks. We'll go over that in just a minute.
You need 2 points to draw a line, obviously. But that doesn't necessarily mean it's a valid trend line. All you have at that point is a line. And what Chip is saying is that at some point, hopefully, the market will come down and test that trend line and bounce off it. And that's when you have a valid trend line. Yeah, in an uptrend, we draw the line under the troughs. In a downtrend, we draw it along the peaks. Okay. Let's see. Everything's going great. Oh, yeah, we're coming back to Apple. The left side of this chart is the same support resistance rectangle from the last chart. Remember that we were in that trading range. Something changed around June 20th, and an uptrend started. It was confirmed around July 18th. The bulls made a comeback. Okay.
And then you can talk about that support resistance change that happened on the red line.
Right. Also notice a hesitation after the initial breakthrough when support turned into resistance. In fact, I have to admit, I have to point out that myself and Arthur both wrote very bullish comments on Apple right around that time. I actually went back and checked. I haven't lately been focusing too much on individual stocks, but this one really jumped out at me. So, but that's a good example now. So that upper line there, that upper red line, once you get a breakout, should become resistance. In fact, another just a little tidbit here. One of the earliest ways one of the nice things about charting, by the way, is not that you're always right, but you can tell very quickly when you're wrong. There's a lot to be said for that. Well, there's a big advantage. For example, if you get an upside breakout, like Apple, for example, it breaks through, I don't know what that price level is, but wherever that red line is, it breaks through it and everything looks great, clear buy signal. Okay, if it falls back below that line, you can tell right off the bat something's wrong. It should not do that. Now, give it a little leeway. But if it falls back below that breakout point, especially on heavy volume, you know right off the bat that something's wrong. There's a big advantage of that, in knowing very quickly when you're wrong.